Hi, everyone, and welcome to Worldwide Education and the very first class of land transfer. Joining me today is Kim Pham, who does all the behind the scenes work to get these classes up and running. Today's class is residential loan options and is hosted by Amul Madera of Citywide Home Mortgage. This class will run approximately an hour and a half and is for 1.5 CE credits. A code will be put up towards the end of the class, which you will have to click on to verify your attendance and ensure you get the credits. Please put any questions you have in the chat, and Amul will get to as many as he can, time permitting. If there are any additional questions after the class, feel free to email him. We're going to do it today. We're going to do some questions after our break. So give yourself, listen to what he's saying, think about any questions you might have, and then we will answer them. We'd like to make this class as interactive as possible today. Amul, thank you for doing this. I look forward to hearing about all the different loan options, and I'll let you get started.
All right. Thank you very much, Peter and Kim. As Peter introduced me, my name is Amal Madera. I'm a producing branch manager for Citywide Home Mortgage, which is the division of Guaranteed Rate, national company. And I also have a company on the side for commercial lending, which is something outside of what we're discussing here, but that is offers us some options as well on residential loans, which is why I kept that information here. We're going to go today through residential loan options, residential lending options. And what I want you to know from the beginning is the philosophy. When it comes to lending, the lenders use specific financial and personal criteria. We often call these the 4 C's. So it's capacity, capital, collateral, and credit. And this is what determines your mortgage eligibility. So right off the bat, we go to capacity. And most people would think about income. Do you have the ability to repay this loan? Just as any other loan, you would go for an auto loan, a student loan, etc. The capacity is, we call it ATR, the ability to repay. The lenders will evaluate your income and existing debt to ensure that you can manage your monthly payments. In the capacity, you will hear the term debt to income ratio, or DTI. Debt to income ratio is exactly what it seems. We are going to calculate your debt as it appears on a credit report, all of your monthly payments. We're going to add on to it your new mortgage payment, your taxes, your insurance, and we're going to divide that by your calculated monthly income. The debt to income ratio, for the most part, needs to be under 50%. In some cases, we do have some exceptions, however. So what lenders are looking for is income stability. They want to see that you have at least 2 years of steady employment history. And steady is the key. If you are jumping around from monthly employer to monthly employer, can you still get a mortgage? It's possible if we make the case. However, you're not showing much stability. You don't necessarily have to be with the same employer for 2 years, but you do need to be at least in the same field of employment in order for that to be considered. So with 2 years of employment history, we're looking at two things. Number one, are you a salaried employer? If you're a salaried employee, you are getting the same paycheck every week, regardless of how many hours you work. That is pretty easy to determine as a salaried employee because we're looking at your pay stub. We can also get the salary letter from your employer. If you're an hourly employee, that changes things. An hourly employee is considered a variable income, and a variable income does need to show at least a 12-month history with the same employer. But ideally, we'd be looking at a 2-year history of the hours worked, of any overtime, of any holiday pay, or any sick pay. And when we come up with the income that we're using, as I previously stated, we would then come up with a debt to income ratio. Now, the ideal debt to income ratio is 36% or lower. That is what's set aside by Fannie Mae and Freddie Mac. However, both Fannie and Freddie on conventional loans will allow a debt ratio up to 50%. And we have listed here 50% for FHA, but FHA recently increased that to a 57% debt ratio. When we are looking at your income, it's important to know for W-2 employees, we're looking at box 5 of your W-2. Box 5 is your total income before any deductions are made. So we are using your income prior to any deductions going to retirement, prior to any deductions for benefits such as health insurance or any other deductions that you may have. Any 401k loans are not counted against you in your debt to income ratio. However, pension loans would be. And I can tell you the reason why is a pension is a pooled set of funds where you do have a set payment going to a third party. If you're taking a loan from your 401k, and we can see that coming off of your pay stub, that is really a loan that you're paying back to yourself. So even the failure to pay that loan does not affect your debt to income ratio. Likewise, we're going to be looking at your pay stubs to see are there any deductions for alimony or child support. Those are the items that, again, we will have to consider with your debt to income ratio. So the debt to income ratio is really broken down into two items, the front end and the back end ratio. A front end ratio is going to be just your new mortgage payment. So Joe Smith is buying a new home for $800,000 somewhere in Orange County. And that $800,000 home is going to have a $600,000 mortgage on it with a monthly payment of $6,000, including mortgage principal and interest, property taxes, and homeowners insurance. When we take that number, that 6,000, and divide it by your monthly income, that is your front end ratio. Your back end ratio is all of your debts combined. So when I take the debts that appear on your credit report, credit cards, any additional mortgages, student loans, auto loans, these are the items that we will add to your front end ratio, then divide by your monthly income to come up with a back end ratio. Those two ratios for an FHA loan needs to be 47% in the front and 57% in the back. For a conventional loan with Fannie Mae or Freddie Mac, we're looking at 50% ratios. It doesn't matter whether it's all front or all back. That is the capacity and portion of the 4Cs. The next we go to the credit. Now, credit is important. What we're looking for credit more than anything on a conventional loan, you need a minimum credit score of 620. With that 620 credit score, we also need a minimum of 3 trade lines that have been seasoned for a minimum of 24 months. So we call that, again, the 2 3s. The 2 3s meaning 2 years of 3 trade lines. Those trade lines could be anything from a credit card, an auto loan, a student loan, but we want to see a payment history. Without the 3 trade lines, you'd be looking at an exception. And in most cases, an exception requires manual underwriting, which most lenders do not accept when it comes to a conventional loan. Manual underwriting, however, is available on government loans. Government loans would be FHA, VA, and USDA. An FHA loan we can give you an FHA loan with a credit score as low as 500. Everybody has a story on why their credit score is what it is. Missed a payment, we're out of the country, we're traveling, had a dispute with a creditor, whatever it may be. But the credit score as low as 500 would require a 10% down payment on an FHA loan, and a 580 credit score or above requires only a 3.5% down payment. Those loan amounts, however, do vary by county, so there is no set parameter for the entire country as to how high we can go on an FHA loan. In some cases, it could be as low as 300,000. In some cases, it could be as high as 1.1 million. It really does matter on the area, and that's a quick lookup that we can do. A VA loan is also a government loan. It's similar to an FHA loan. It has similar characteristics as far as approvals. However, there is no debt to income ratio that or no real credit score. However, it is typical 500. A VA loan does require what we call an AUS approval. So even if you have a 72% debt to income ratio, you could still potentially get the approval. As long as our automated system approves that loan, you are good to go. VA loans can also come with variations such as renovation loans, construction loans, or jumbo loans. But that's something we're going to tackle a little bit later in this class. And then finally, you have a USDA loan. A USDA loan requires a 640 credit score and has very strict parameters on the debt to income ratio of 28 and 41. That means that your front end ratio, your new mortgage payment, we'll call it a housing payment, your taxes, insurance, mortgage principal, and interest, all together combined, cannot exceed 28% of your monthly income. Likewise, when I add the rest of the debt that you have, any kind of credit card, student loans, and that could be student loans that you've also co-signed for children. Auto loans, again, if you co-signed for an auto loan, we do have to hold it against you. That number cannot exceed 41%. There are really no exceptions when it comes to USDA. It does say that manual underwriting is permitted. However, it's a rare case that manual underwriting is going to be approved. So again, we'd be looking at an AUS approval. Now, that also, while we're on the subject of credit, you want to look at the credit report details. What are we looking at? We're looking for late payments. If you have a late payment for a mortgage within the last 12 months, you are not going to be able to apply for a mortgage until that late payment is seasoned for at least 12 months. We're looking at high credit utilization. So when you have credit cards that are above 30%, or even a home equity line of credit that's above 30% of the max allowable balance, that will affect your credit score. And then hard inquiries will also affect your credit score. If you have too many inquiries in a short period of time that are considered hard inquiries, it is possible that your credit score goes down. It is not a significant drop. It'll be maybe 2, 3, at the most 4 points. However, if you're on a tier such as 700, dropping from 700 to 696 does affect your pricing. If you have an 800 credit score and you go down to 790, it doesn't really affect anything. And please stop me anytime if you do have a question. While we can't speak directly, you can put the question in the chat box and we will address any questions you have. Next, when it comes to the 4 C's, the third one is the capital. Capital is the assets. Lenders want to see that you have enough assets, enough cash for the upfront cost, the down payment, the closing cost, as well as what we call emergency reserves. Different types of loans will require different amounts of reserves. If you are buying an investment property, a rental property, a lender will generally ask you to have 6 months reserves on top of your down payment and closing cost. So let's again give an example. Joe Smith is buying a home for $800,000. The down payment requirement on that is 25% for a rental property. So we want to verify the $200,000 down payment. We want to verify the approximately $20,000 or so in closing costs. That's going to be lender costs, title fees, plus any taxes due to the state of New York for the mortgage tax, as well as any deed or transfer taxes, realtor commissions, etc. We want to verify they have the closing costs ready. We want to verify then proof of reserves. This gets interesting. Now, reserves have to be liquid assets, but they don't have to be necessarily immediately available. And we're not asking you to move anything from one account to another. Proof of liquid assets can be a retirement account, a 401k, an IRA. It could be stocks. It could be the cash value of a life insurance policy, something that you're not necessarily going to access immediately, but we want to know that it's something that you have access to in the case of a rainy day. If Joe Smith loses his job and is unemployed for 6 months, does he have 6 months worth of mortgage payments stored away somewhere so that he can continue to pay back the loan without affecting the loan terms in any way? Okay. And then when it comes to closing costs, it does go state by state. The state of New York is a little bit more expensive than most because the state of New York has a mortgage tax. If we're looking at the state of New Jersey, the state of Pennsylvania, I would say the average closing cost is 2%. If we're looking at the state of New York, we're probably looking at more of 4%. And in New York City, in the 5 boroughs, more like 5%. The 5 boroughs have a mortgage tax of 2.25%. What that means is that if you're taking $1 million mortgage, 2.25% would be $25,000 that you're paying in a mortgage tax. And out of that $25,000, the lender will pay 0.25% and the borrower will pay the rest. So it is an exorbitant amount that goes on top of your normal closing costs. Again, this is only at the time of purchase, but we're going to want to make sure that you have that money available, and we're going to need to verify prior to the approval, the final approval, that this money is available to you and in your name. And finally, the last of the 4 C's is the collateral. What helps determine the approval, what helps determine the rate, what helps determine even the eligibility is going to be the type of property and the value that we're looking at. So the property itself is the collateral for the loan. When you hear the term mortgage, The mortgage is not the loan that you're paying back, but the mortgage is an actual document that serves as the collateral for the loan. The loan itself is described on the loan note. The value of the collateral must be verified through a professional appraisal. And in some cases, a second appraisal could also be required depending on the property that's being purchased. So when we come to occupancy, this has a lot to do with the collateral. A primary residence, this is the home that you're living in with your family. This is the home where you live through majority of the year. Yes, of course, you may have a vacation home and you may travel, but majority, this is your primary residence, will be the home where your family stays, the home that is listed on your ID, whether it's your passport, your driver's license, all of your documents, your tax returns. Where are they filed? They are filed using your primary residence. Your bank statements will have your primary residence. Your pay stubs will have your primary residence. And that is very important because a primary residence is where you're going to get the best rates. The reason being is that all rates are based on risk. And the lowest amount of risk you have, or lowest amount of risk that a lender takes, is on your primary residence. Again, let's go to Joe Smith. If Joe Smith has lost his job and is unemployed for 6 months, well, it's very unlikely that Joe Smith is going to miss a mortgage payment on his primary residence, where that's the home where his children live and go to school, versus, let's say, a second home, a vacation home, or an investment property. If Joe Smith gets foreclosed upon a rental property or a vacation home, it's not going to affect his family's day-to-day operations as much as it would a primary residence. Therefore, a primary residence based on a lesser risk to the lender is going to give you a better rate. For instance, a primary residence rate today on a 30-year fixed, 20% down on a single-family home would be roughly 6.25%. If we go to a second home, that same property is now a beach home or a ski chalet. Or it has to be at least 100 miles away from the primary home itself, and preferably in a vacation area. If that home were to go into foreclosure, it would be less likely that Joe Smith is going to rob Peter to pay for Paul in order to make sure the loan is paid. As a result, the second home is going to have a little bit of a higher rate. A second home rate is similar to an investment property rate. And while there's no exact formula, if I were to do the rate today would be about 7.125, slightly less than 1% higher than the rate on a primary home. A second home advantage, however, over an investment property, even though the rate would be the same, on a second home, you can put down as little as 10%. On an investment property or a rental property, you will have to put down a minimum of 20%, and in most cases, 25%. The reason is that there is no PMI companies that are insuring investment homes. So without any PMI, it's too much of a risk for the lender to let you put down less than 20% on this type of property. An investment property, again, is considered an investment property as long as it is rented out for more than 12 weeks out of the year. If it is rented out for less than 12 weeks out of the year, it can still be listed on the Schedule E of your tax return. However, it can be considered then a second home and not a rental property. Right? The property condition at the time of appraisal is a very big deal. I know as real estate agents, you guys, men and women, will avoid FHA and VA as much as you can because you know that the appraisals are a little bit tougher. And it is very true. If you have an FHA or a VA loan, I think the most popular condition that we see coming back on appraisals is having to repaint the windowsill. There's paint chipping from a wooden windowsill. To the average person, it means, why is this an issue? And I agree with that. However, FHA, the government has set specific standards that they want for anything FHA, VA, or USDA. And in most cases, these repairs have to be made prior to closing, if any repairs are required. For the most part, you are looking at a property that has to be inhabitable as an as-is condition. It doesn't necessarily we're not going to check for a CO. However, if it's a new construction, we will require that a CO is issued. A temporary CO is also acceptable. But the property itself has to be movable at the day of closing in as-is condition. If it is not inhabitable in as-is condition, and this is and we discover this during the appraisal process, then the loan it doesn't have to be canceled. It can be flipped over to a renovation loan. And instead of doing the traditional purchase, a renovation loan will, on the day of closing, give the seller the entire purchase price, so the seller is satisfied, and the buyer will then get access to X amount of dollars to fix the property up so that it is inhabitable in a certain time frame, generally 6 months or so. When for the renovation loan, we add all of those things up together, that becomes your final mortgage. But that's something that we will figure out. I think in most cases, real estate agents are going to know whether or not a property is going to pass the appraisal. And that's the 4 C's. That is really where the lending philosophy, that's where the lending risk comes from. That's how the pricing is determined. That's how the guidelines are determined. And guidelines, we are going to go over it a little bit after the break. We're going to do this a little bit different when it comes to the different guidelines for the loans. Instead of just having to hear me speak, we're going to take a little break prior to going over the loan types. And I'm going to ask everybody participating today in the class to come up with scenarios, or maybe review a scenario that you had in the past that made lending a little bit difficult. And we can go over the loan options more interactively to see what works so that you can be a little bit more hands-on with the seminar. So this takes us to the residential property types. I purposely did this after the collateral because the property types are part of the risk factors that come into determining the rates for the loans as well as the guidelines. And it's very important that we know the different types of residential properties. You have your traditional single family detached. A single family detached home is a standalone house on its own, on a plot of land, or on its own plot of land, meaning it doesn't share walls with other residences, and you do own the property and maintain the property as well, the land. A single family attached property, a residential property that shares one or more walls with adjacent homes, but functions as its own distinct residence with its own private entrance, foundation, utilities. And I should add in there that it also has generally a small backyard or something along those lines. So it does have its own land. Think of a single family attached as the row homes that you would see in Philadelphia, or the row homes you would see in Brooklyn, right? Some of the brownstones that you're seeing in downtown Manhattan, those would be considered row homes. They're sharing walls on either side. However, they do have their own foundation. They do have their own entrances, and they do function separately in terms of ownership. Condominium, this is probably the most common when it comes to city living. Condominiums where you own the interior space, but you share ownership for the common areas like the roof, the land, swimming pools, tennis courts, hallways, anything else that is basically maintained through a homeowners association. And you know that it's a condo because the homeowners association will also have a master policy for insurance. So if you're buying a condominium, you as a buyer would be getting what we call an HO6 policy, a walls-in policy, where you're covering your portion that you own, which is the interior. The exterior of the property is still owned in, I would say, conjunction with others, because those are all considered common areas, whether it's your roof, whether it's, the playground in the middle of the development. Now, it does become interesting because when you look at townhouses in a lot of cases are considered condominiums. So it's a matter of zoning. Did the developer zone the property as a townhouse, or did they zone it as a PUD? A PUD would be a planned unit development. A PUD functions more like a single family attached home. You have your own foundation, you have your own utilities, you have your own private entrances, and you own the land upon which the house is laid upon. If it's a condominium style townhouse, it could still look like a townhouse, multiple levels. However, you are sharing the common elements once again. You do not own the land. That land is being maintained by the HOA, and you'll know that it's a condominium zoning because the HOA fee will be a little bit higher than as if you were buying a PUD or a planned unit development. A planned unit development would also allow you to purchase individual homeowners insurance similar to a single family home versus a condominium walls-in policy. And then, of course, we have your traditional multifamily. Traditional multifamily is either a 2, 3, or 4 family home. They're going to have separate living units. They're going to be either stacked or laid upon next to each other. They're designed for families to live independently, but within one structure, having its own kitchen, living space, and entrance. So this almost, a 2 to 4 family is basically a small version of an apartment. You're going to have one owner. The owner can live in one of those units and they can rent out the other 3 units, or in a lot of cases, the owner will rent out all 4 units. Most of the time, this is going to require 20% down. However, in very few cases, with limitations on the loan amount, a first time home buyer can do as little as 5% down on a multifamily. That's something we'd have to look on a case by case basis. There's not a lot of places in New York that is going to allow for that 5% down, only because of the cost of living and the price of real estate in New York. And then finally, of course, we have our very favorite, our co-ops. Our co-ops involve buying shares in a corporation that owns a residential building. When you have a co-op, you own you own part of the co-op. You don't necessarily own your unit, even though it feels that way. It's more of an apartment style living where you have multiple owners of an apartment. When you have your HOA fee in a co-op, that HOA fee is going to include property taxes. It's going to include insurance. So the HOA fee will be a little bit higher than what you see in a condominium. However, financially, it probably all comes out to be the same because you still have to pay property taxes when you own that condominium. Co-ops can be a little bit tricky. Not all co-ops are approved. In most cases, lenders have only approved co-ops in 2 areas in the country, which is New York City and the other one being San Francisco. Most co-ops in other cities are not lender approved and generally take on private financing. Co-ops also require additional work post closing. So once we have our clear to close ready, we now have to also deal with the co-op board and all of the additional co-op documentation that needs to be presented to the lender and the title company prior to the actual closing. If we got our clear to close on January 31st, I wouldn't expect to close on that co-op till probably February 13th. So expect it to be about a 2 week difference when it comes to co-ops. Co-ops will also require 20% down because most lenders are not giving PMI on co-ops. There are exceptions to that, and those exceptions again are on a case by case basis. And while I'm not going to necessarily focus on any of these property types, being that I am speaking to a New York audience, these items are going to come up quite often. So we know what a mixed use is. The reason I put mixed use up to 8 units is most lenders are comfortable with a mixed use property that has a commercial space on the bottom and up to 8 residential units on top. If we have more than 8 units, and for the most part, we are looking at either a credit union or hard money to finance that. Majority of the national lenders that you're familiar with are not comfortable with mixed use with more than 8 units. Office space or retail space, real simple. This could be a home, this could be a condo, this could be anything. But if the full use of it is only for commercial use and there is no residential use for it altogether, it is considered full retail space. And that again is going to go through commercial financing, something that we're not necessarily going to be tackling here today. Anything that's more than 5 units is no longer a residential property and is considered an apartment building. So whether it's 5 units, whether it's 15 units, whether it's 50 units, it's going to be considered an apartment building. Resident financing on this is again going to require a minimum of 20%, but it is going to be commercial financing. We do have residential loans that apply to apartment buildings, and that is what we label that under non-QM. Non-QM is essentially commercial financing and something that we're going to go over after the break. And then finally, when it comes to property types, we have spec housing. If any of our audience here does work with developers are always looking to build spec housing. You're not going to see it in New York City or the 5 boroughs because, there's barely enough room to park a car in the 5 boroughs. But if you do go out west a little bit, Orange, Westchester County, places like that, you may have a developer who's buying a specific plot of land, looking to build a specific home without a buyer in mind, but using that as a model to then sell either that exact home or sell additional homes. That's called spec housing, short for speculative housing. And that again, we go through commercial lending for that. That would be new construction lending, and that can be a little bit difficult, but probably something that we're not going to come across too often. So if we have spec housing questions, I'm going to ask you to just send them to me directly. Okay. We are going to take a little bit of a break right now. This is just the boring. I'm going to read all the definitions part of the seminar here, part of the class. The second part of the class, we're going to move more into the Q&A part, where I'm going to ask any of the participants to give me specific scenarios so that I can show you the different loan types. If we don't have enough scenarios to cover all the loan types, I'll still go through all the loan types, but make up the scenario so that it's easier to understand using specific examples. Peter?
Amul, we do have a question if you want to
Oh,
field one
sure.
before the
Okay.
break.
Mhm.
Problem for me is a deal where an owner of a retail condo rented the unit for rented use, as was their right, and almost 2 years later is still bickering with condo board and tenant build out that space with venting to the roof.
Yeah, I mean, I understand the question, but it seems more of a legal question. If we're talking about, financing, in terms of financing, as long as the approvals and permits and the board approval and the HOA was okay with venting the roof, then we can certainly provide a loan to help finance whatever construction is required. But it seems more like this is I don't know if Faith is not on this call. This is really a faith question more than anything. Peter, I would think, right?
Yeah, maybe we could put Benjamin in touch with Faith to answer this question after the class.
Okay, perfect. Yeah, I think we should do that. Benjamin, thank you very much for your question. When we mentioned Faith, we're talking about another business partners of ours who is phenomenal attorney, literally the Johnny Cochran of real estate. Just an amazing attorney, and she handles majority of the country, but her specialties are the Northeast, New York, and New Jersey. So we will either Peter or I will send you Faith's contact information, and feel free to review this issue with her. And if there's any questions on financing, then I'm more than happy to answer any financing questions.
Okay, yes, after the class, I'll send out a group email. I'll copy you too, Amul, and we'll
Yeah.
copy Faith, and we'll get that answer.
Yeah.
All right. Do you
Okay.
want to take a little break now?
Yeah, let's do the 10-minute break, and it's 11:35 now. Why don't we come back at 11:45? And if any of our participants could in that time come up with specific scenarios, that would probably be interesting to everybody involved. Otherwise, I could make up scenarios as we go along through each different loan type.
Sounds good. All right, we'll see everyone at 11:45 and get your questions ready. Thanks, Amul. All righty, welcome back. No questions yet in the chat. So, Amul, if you want to pick it up from here.
No problem. Okay. So your traditional mortgage programs are known as qualified mortgage loan programs. These are the programs that every lender in the world carries, your Bank of America, your Wells Fargo, your Loan Depot, whoever it may be, a guaranteed rate. This is my company. Qualified mortgage is basically your full documentation loan. It is 2 years of income docs, whether it's W-2 statements, tax returns, pay stubs. We want to see 60 days of bank statements. We want to see a 24-month credit history. So when we talk about qualified mortgage programs, these are the Fannie Mae, Freddie Mac loans, as well as FHA, VA, and USDA. We're going to start with your conventional loan programs. This is when you hear the terms Fannie Mae and Freddie Mac, these are the conventional loan programs. They are not insured or guaranteed by US government, but rather by private lenders, and most adhere to guidelines set by the government-sponsored enterprises known as GSEs, Fannie Mae and Freddie Mac. They are the most common type of mortgage in the US and offer flexible options for various types. Let's get beyond the words over here. Fannie Mae and Freddie Mac essentially are the ones that determine what we call loan level pricing adjustments. A loan level pricing adjustment would be, okay, if somebody is putting down 10%, they're going to get this much of an adjustment to the price versus somebody putting down 40%. That again is based on risk. Okay. Those government loan program risk factors are also based on the 4Cs. They'll determine at what point is your credit score a risk, at what point is the property type a risk. Okay. Now, with a conventional loan program, a first-time home buyer can put down as little as 3%. If you're not a first-time home buyer and you're buying a primary residence, you can still put down as little as 5% on a conventional loan program. Okay. There are certain loan limits. Those loan limits are being increased in January, or this got increased, I'm sorry, this January. So you could put down 3% on a loan amount as little on a purchase price, as little as $1.1 million. You could put down 5% on the same thing as well. A conventional loan will allow up to a 50% debt to income ratio, let's say 49.99. We want to keep it under 50. And it does, and they're looking for either 1 to 4 unit dwellings, single family, attached, detached, doesn't matter, townhouses, or a condo. Okay. A conventional loan can be either a primary residence, it could be a vacation home, a second home, it could also be a investment property. And this one is very important for nowadays. If you're taking notes on anything, take notes on what I'm about to say. With the prices skyrocketing as high as they are right now, conventional loan parameters will allow for a co-borrower parent to be on the loan, but still consider it a primary residence. So again, if Joe Smith just graduated college, has a ridiculous amount of debt, is making $80,000 a year in his first job, but he's trying to buy that house in Westchester County. His parents can also be on that loan with them. We can use their income, credit, debt, all of the necessary items, and they will be called what we call a non-occupying co-borrower. And this applies whether it's a parent buying a home for a child buying a home for a parent, and so forth. It can go either way. If you have, again, somebody who is now retired and they're looking to move into one of those 55 and over, but they don't quite qualify on their own, they can use their children's income, credit, etc. qualifications to do that and still call it a primary residence and get all the benefits of a primary residence, such as the lower down payment requirement, as well as the lower rate. Okay. A conventional loan is your regular loan. Joe Smith is buying a house for 600, 800, let's say $800,000. He's putting down 10%, $80,000. He's getting a $720,000 loan. That's also going to be resulting in PMI because he's getting less than 20% down. It is the traditional loan that you see advertised left and right. This is the market rate, the bank rate, etc. We go next to an FHA loan. An FHA loan is a government insured mortgage. It basically insures private lenders so that when they give loans to higher risk applicants, higher risk meaning somebody with a limited credit history, somebody with a lesser down payment, somebody with a lesser income possibly. A lender can still make that loan and know that if that loan were to go belly up, it is insured by the federal government and the lender will get the money back that they put out for the loan. So an FHA loan requires as little as 3.5% down. They can use limited and non-traditional credit. A perfect example for an FHA loan would be somebody who just came to this country maybe a year ago, and they did establish a 1 year credit history, a 1 year residence history, a 1 year employment history, but they don't have the requisite 3 years that or 2 years that's required by conventional loan programs. With that being said, we can use limited credit, we can use non-traditional. Non-traditional credit would be anything that doesn't appear on your credit report, your cell phone bill, your auto insurance, your utilities, electric, water, gas. These things don't appear on your credit report. However, if those are the items that you have without having any credit cards or student loans, all you need to do is provide a payment history and we can turn that into non-traditional credit, which FHA will allow. Okay. FHA will allow up to 4 units, but I separated it on purpose. So again, people that are dealing with multifamilies and dealing with FHA buyers, I want you to know this: 1 to 2 units, that's fine. We can use the rental income, plus we can use your regular income to qualify you. When you have 3 to 4 unit property on FHA, FHA by its very existence needs to be a primary residence. So if you have a 4 family property and you're living in one of them, you have 3 units that you're able to rent. The rent collected on those 3 units multiplied by 75%, we use a 25% vacancy factor, multiplied by 75% need to cover the entire mortgage. Let's do this more through an example. We have a multifamily property being purchased at $800,000. The down payment is going to be your minimum 3.5%. The mortgage payment with taxes, insurance, etc., comes out to $7,000 a month. That means that units 2, 3, and 4 combined need to have a rental income of a minimum of $9,400. $9,400, we're going to subtract 25% from that, which will give us a little bit over $7,000. That will cover the mortgage, taxes, insurance, and what we call as well as the PMI, what we call the full housing payment. So on 3 to 4 units for FHA, the rental income itself, the unit needs to be able to stand alone on just the rental income without using any of your W-2 or employment income. On a 1 to 2 unit, that does not apply. For FHAs, for FHA, VA, and USDA for that matter, a condo must be FHA approved. You can go to Google, type in FHA approved condos. HUD has a website where you can plug in the information, almost like you're shopping for Amazon. You put in the filters and the parameters, and it will let you know whether or not a project has been approved, whether that approval has expired, or whether a project has been rejected by FHA. VA will need the same thing. USDA will need the same thing. If a condominium project is not FHA approved, but not rejected by FHA either, we can do a one-off spot approval. That will take an additional 4 weeks on top of normal financing time. So if you know that if the spot approval is required, I would definitely suggest to do a 60-day or longer contract. Okay. Also, I'm going to go backwards for a second. You see on the bottom here, MIP. In the world of government, mortgage insurance or PMI, it's not private. So it's just considered mortgage insurance premium. In the world of conventional loans, we call it PMI because it's private mortgage insurance. A conventional loan is a private loan. An FHA loan or a government loan is insured by the federal government, so it's no longer private. VA loan programs, you can do as little as 0 down. And this is very important because we do want to give back to our veterans. Keep in mind that our veterans, if they've been overseas for a few years, it might be a little bit difficult to make your Chase credit card payment from the middle of a desert in Iraq. That being said, we do not have debt ratios when it comes to VA loans. VA loans can finance a 1 to 4 unit property. It can finance a condo or townhouse. They come in 15, 20, and 30-year terms. 30-year terms include adjustable rate mortgages. You can do a a 5/1 ARM, a 5-year adjustable. There is no prepayment penalty on any residential loan. So whether it's VA, USDA, conventional, or FHA, any primary residence nationwide cannot have a prepayment penalty. Again, for VA, we can use limited and non-traditional credit. And VA does have add-ons for construction and renovation, meaning if you are eligible for a VA loan, then you are also eligible to do a renovation loan through the VA with 0% down. Now, when it comes to VA, there is no monthly PMI. However, there is a 2% funding fee at the time of closing. Let's use easy numbers. If somebody is buying a home for $500,000 and they're getting a $500,000 loan with 0% down, that loan will actually be $510,000. We're going to take 2% of the loan amount. So 2% of $500,000 is 10,000. We will add it to the balance. So the borrower does not have to pay that 2% upfront in cash necessarily, unless they want to. They can finance it into the new loan. And USDA has almost the same. The USDA, however, is a little tougher for qualification. You have a 28 and 41 debt to income ratio. I'm going to pause for a second. Before the class started, everybody who is in the class should have received a glossary of terms. If there's any terminology that I'm using that you're unfamiliar with, please, by all means, go ahead and ask the question in the chat box, or you can go ahead and refer to your glossary. I put the glossary in alphabetical order, and it's also in a PDF format so that you can use the find function if there's any specific terms you are looking for. So with that being said, the USDA has a 28% front ratio, 48%, a 41% back ratio. Here's the one with the USDA is, again, you can Google this. There's an eligibility property lookup tool. You not only want to look up the eligibility for the property itself, but it does need to be lower to moderate income. So in that specific place where that property is located, you'll put an exact address. The lookup tool will also let you know the maximum income that is allowed per borrower for that particular property. Deed restricted properties are allowed. We can use USDA on deed restricted properties. We call them lower to moderate income properties that are set aside by developers. Those are generally deed restricted because you cannot sell them back for a profit. FHA, VA, USDA is perfectly fine with that. And once again, there is no prepayment penalty on these. These are the 4 types of traditional mortgages. I know there's other mortgages that can come up. Adjustable rate mortgages would generally come up under conventional loan programs. Jumbo loans are basically conventional loan programs that require a higher down payment and higher reserves. But you're going to go by the same Fannie Freddie guidelines to qualify for a jumbo loan as well. And a jumbo, again, the numbers are ever changing. A jumbo used to be anything over 417,000 15 years ago. A jumbo loan now in New York City is anything over 1.1 million for a loan amount. And now we get to the fun stuff. So we did the conventional loan programs. We did the regular loans that everybody sees all day and night that everybody can offer. Now let's get to the ones where people don't necessarily qualify. And those are called the non-qualified mortgage loan programs. In short, they call them non-QM, and we call this alternate documentation. Alternate documentation can be an array of things. So let's go over them one by one. And again, please feel free to stop me with any questions that are in the chat bar if you have any specific scenarios that you want to use. The most popular for all non-QM loans would be the DSCR. DSCR is debt service coverage ratio. In short, you are qualified to purchase a rental property based on the rental income. Okay. So what we're doing is we're skipping the tax returns. We're skipping the pay stubs. We're skipping the W-2s. We don't need any of that stuff. All we need to really qualify you is a credit score, minimum 660. You are going to close this loan. It's considered a business purpose loan, even though it's a residential property. You will close this loan in either an S Corp or an LLC, depending on the state that you're in. There is no debt to income ratio. The only ratio we're looking at is the rent to payment ratio. So again, let's look at Joe Smith. He's buying a property for $800,000. He's putting 20% down. His total payment, we call it PITI, principal, interest, tax, and insurance, is coming out to $6,000 a month. Well, in order for Joe Smith to qualify to buy this property as a rental, the rent on that property needs to also be a minimum $6,000 a month. That rent is going to be verified by the appraiser. So at the time of the purchase, if the property is vacant or if it's not currently a rental property, the appraiser will determine what is the average market rent for this property or what should it be. We really don't want to rely on the appraiser to do that. If you're a real estate agent, a listing agent, a buyer's agent, and you have somebody buying a rental property, please come equipped to the appraisal with comps ready, with comps that are already rented to provide to the appraiser so that they can do a more accurate assessment of what the rental income should be. If we are not using the 1007 rent schedule, then we would be using the lease if there's an existing lease on the property. Okay. And with that lease on a DSCR loan, we don't need to use a vacancy factor. We can use 100% of the lease amount. So it's a very generous loan and a very easy one to close. In fact, we just closed one in December that took, I want to say, 24 days from the day of the application to the day of closing and funding. And that included 2 weekends in between. That was 24 calendar days and not business days. Excuse me one moment. Now, one of my favorites getting out of the DSCR when we get back, a DSCR, by the way, has to be a rental property. It cannot be used at all on your primary residence or vacation home. It is strictly for rental properties. And a DSCR could be a residential property. It could be a commercial property. If you have a 50-unit apartment building, we're going to go DSCR. If you have a mixed use, we're going to go DSCR. If you have a single family, a condo, a townhouse, a co-op, whatever, we're going to go DSCR. When we go to a primary residence and you have a self-employed borrower, and this is my favorite example, it's going to be the pizza guy, okay? The pizza guy for the longest time has been working in cash. He's been putting cash into his bank account, but like a smart self-employed borrower, they're minimizing the amount that they're paying in taxes. So when I look at the pizza man is probably not going to show much when it comes to income when I look at his or her tax returns. However, when I look at his or her bank statements, I can see that he or she is depositing, let's say, $5,000 a week in cash, credit card receipts, all of the above, is depositing all of this a week. So on paper, they have an income of $20,000 before any taxes are paid or any expenses are paid. However, on a tax return, they may be showing only $25,000 or $30,000 a year. This, of course, drastically affects the qualification. So when we have a bank statement program, we're going to use either 12 or 24 months of business and or personal bank statements. We can combine the two. We're going to add up all of the deposits made that are business deposits. If I see $50 coming in from a Venmo, from your friend paying you back for dinner, we're not going to count that. We're going to know, which are business deposits and which are not. So we'll use all of the business deposits and we'll take 50% of that. So in the case of Joe Smith, and Joe could be Joseph or Joanne, which is why I say his or her. In the case of Joe Smith, if he or she is showing $20,000 a month in income, in deposits, we're going to use $10,000 at that point to use as the monthly income. This is a non-QM loan. So like all non-QM loans, we are going to have to require 20% down. Now, what's nice about the bank statement loan is, let's say Joe Smith is the pizza man or pizza woman, self-employed, but his or her spouse has a regular W-2 job making $120,000 a year. We can combine the two. It doesn't have to be one or the other. And even if Joe Smith himself, as the pizza man or pizza woman, has a secondary part-time employment in which he or she is making an additional $40,000, $50,000 a year, we can use that and combine it in or add it onto the income, the bank statement income. When I use the term passive income, that could be a pension, an annuity, Social Security. It could be anything. It could be just a part-time job. Okay. And again, when we have prepayment, primary or second homes, there is no prepayment penalties on this. So traditionally, a bank statement loan is great for the person who is working in cash. Traditionally, the pizza place, the bagel place, the gas station, the liquor store owner, the convenience store owner, the dry cleaner, a lot of the small businesses that traditionally use cash. I know nowadays we use cash less and less, so it's less of an issue, but then it also comes down to how much are they um, deducting on their tax returns? How slick is their CPA? Okay. We'll go to asset depletion, asset qualifier. Again, you have the parameters that are down here. You're going to get a copy of this form as well. The how do we use asset depletion? It's really for retirees. It could be used for anybody that, for all intents and purposes, hit the mother load early in life. But for retirees, if you are no longer working, I'm going to use my father as an example. In 2016, my father moved out of our family home after my mom passed away, and he was buying a new property a few towns away. At that time, because he had received mom's retirement, mom's life insurance, there was no need for him to dip into his own retirement. The only money that he can claim at that point as income was Social Security. Well, let's be honest, $2,000 a month Social Security is not going to buy you a property in New Jersey, New York, or probably anywhere in the Northeast. So what we were able to do is take the sum total of dad's retirement assets, and then using a formula in the general case divided by 84 months, that's how we come up with a monthly income. So again, let's use an easy scenario. Let's say you are 65 years old, you have just retired, you have $2.5 million in retirement assets between your 401k, your money market, cash value of life insurance, etc. We're going to divide that by 84 months, and that is going to give you an income of $29,761 per month. What we're not going to include, however, is any money that you're using for the transaction. So if you have $2.5 million in total assets that we can verify, but out of that, you're using $500,000 for this transaction between down payment, closing costs, etc., that leaves you with 2 million. We'll divide that by 84 months, which now makes your income 23,800 a month. So again, when we have somebody who's sitting high on assets, has a lot of money to spend, doesn't necessarily want to deplete those assets, but is willing to use those assets as collateral against the loan, we can basically do an asset-based program. No ratio. We laugh about this one because no ratio used to be our drug dealer program. I don't know if that's inappropriate to say in a classroom situation, but let's use Tony Montana, our favorite drug dealer, as an example here. Tony Montana has sitting on about $10 million liquid in his various accounts. However, he is not able to tell you where his income comes from because it's coming from, selling cocaine on the streets of Miami. And I apologize if anybody's offended by my example, but this is really the most clear way to explain this loan. This loan, when we go to your loan application, your employment section will be completely blank. We will not fill in any employment. We will not fill in any income. There is nothing that you put there. You are strictly being qualified off of your credit score, the property itself, and the assets that you're using to cover the down payment, closing costs, and reserve requirements. This is 20% down as well. You're going to ask, why wouldn't everybody do this? This is a higher rate loan. There's no doubt about it. Okay. When we're looking at this type of loan, you're looking at a minimum rate of probably 8.25 on a 30-year fixed rate. You're probably looking at paying at least 1 point with that rate. And so it is going to be, a risk-based scenario where the lender is going to charge you for the risk that they're taking. But again, when we have a need for this, when you have somebody who is literally not showing any income, possibly not even filing a tax return at that point, or possibly not employed, period, not receiving any income, but just sitting on a bunch of assets, we can then go ahead and do this type of loan. It's called no ratio. And then for people that are employed, there are 3 other types of loans that really do need, there is a backup. I got to tell you, these 3 loans, I'm going to tell you that they exist, but I'm going to also tell you, I'd be surprised if they're used even 1% of the time. 1099 income loans, we're going to use strictly your 1099s. We're going to use your 1099s, and like a bank statement loan, we're going to divide that by 50% because you haven't paid taxes or made any deductions. So very similar to a bank statement loan, we'll take the income right off your 1099s. For you guys as real estate agents, probably it would work. You guys all receive a 1099. However, the 1099 income that you receive is hardly the income that you're paying taxes on by the time you're done deducting dry cleaning, traveling expenses, and anything else that has to do with your work. The P&L, profit and loss, is for self-employed people. It allows business owners to qualify based on a profit and loss statement that is prepared by a licensed CPA. So that's the hard part. If the CPA is preparing your tax returns, chances are whatever P&L he or she prepares is going to be similar to your tax returns, because your tax returns at the end of the day are just basically a giant P&L. If you have a CPA who's willing to play ball, hint, hint, that's a different story. We will use the P&L income generally based on a 24-month period, but 12-month with exceptions. And you need a minimum 660 FICO. This P&L needs to be signed by the CPA. Okay. CPAs are very careful with their licenses. So it's going to be very far and few between that a CPA prepared P&L is going to look any different than your tax return already looks. And then WVOE stands for written VOE. Written VOE is a written verification of employment. So instead of in lieu of W-2s, in lieu of pay stubs, we're going to get a written verification of employment from your lender. A good example of this might be somebody who's working under the table. Okay. The only caveat to this is on any of these loans, we're going to be ordering an IRS 4506C to see if the income that we are using is anywhere similar to the income that we're getting from either the employment verification or the P&L. Now, you would ask, if somebody's getting paid in cash, why would they file taxes? Technically, they have to. That's why. Just because you're getting paid in cash doesn't mean you're not supposed to report it. And then the last two. This is going to be big in New York, I'm sure. The ITIN loans or the foreign national loans. We can do loans for people that are foreign nationals that do not have a U.S. credit history, that do not have U.S. employment, that do not have U.S. residence. They are allowed to purchase homes in the U.S. They are allowed to finance them. They are going to require a minimum of 35% down. Certain lenders may require 40% down. Okay. Again, 50% DTI, but we're going to use both foreign income and a foreign credit report. And a foreign credit report we might have to use a approved translator as well, because I would assume that a credit report that we are getting from a non-English speaking country the credit report would not be in English. While we can get an English credit report from India, we can get an English credit report from Australia, we're not going to get an English report from any of the old Soviet republics or Russia at this point. So it would have to be translated. Okay. And then finally, this is something that you're rarely going to come across, but we can use it if needed for rental, for investment properties only on residential properties. And that's hard money loan programs. When all else fails and you don't qualify for anything else, you qualify for hard money. And hard money is exactly what you think. It is an exorbitant rate. Hard money rates are probably around 11% right now, and you can expect to pay 2 points. Hard money will lend on just about any type of property, including lots, empty lots, including a parking lot, including whatever. But we're supposed to stick to residential today. So let's fixate on 1 to 4 units, condominiums, townhouses. If you need to do a purchase, renovation, if you need construction lending options, hard money is the quick solution. Hard money is also generally a 12-month loan that is interest only with a balloon payment. So the expectation is that you're going to refinance out of hard money, or you're going to pay it off in full, whether it's by selling the property in question or whether it's by refinancing the loan or just paying off with your own cash funds. And that's where we go when it comes to residential loan types. I'm going to open up the floor for Q&A. Anybody have anything, any scenarios they want to run? And you don't have to give me a private scenario. Let's make the scenarios public, because if there's 18 people registered for this class right now, I'm sure there's 17 other people that have run through the same scenario you have.
No questions yet, but come on, we have a few minutes. So if anyone has anything, a scenario, a question, now's the time. Amul, thanks for all that great information. And I didn't expect to get a Tony Montana reference this morning.
It
But
usually wakes people up.
yes, yes, it did that. A little bit of Scarface on a Tuesday
Yeah.
morning.
Everything that I went through today is going to be sent to you. This exact deck that you're looking at is going to be sent to you with a certificate after this class. So you will have my contact information. You will have all of these loan types, loan parameters. If you have scenarios that come up or something comes to mind after this class, again, please send me an email. There is no limit to how many times you can bother me. I am more than happy to be your mortgage encyclopedia. I was about to say Encyclopedia Britannica, but I'm going to date myself, so I'll call myself Mortgage Google instead. Um,
I get the reference, but
yeah,
I'm definitely aging myself there.
yes. So I'm
But
more than happy to be Mortgage Google. Please, to everybody listening, please send me any scenarios that you think may or may not work.
yeah, and I could just say I've worked with Amul for a number of years now, and he's very, very big on communication. He gets things done, and like he said on that DSCR example, he got it done in 20 something days. So, definitely
24 days with 2 weekends in between, so really
that's
20
awesome.
business days. Yeah,
That's awesome. So not even business days. So that's great. But yeah,
yeah.
definitely reach out and any questions, any scenarios, and you won't be disappointed. We do
And I
have a
know we're
poll,
here.
not a poll
I'm sorry,
question, but
Peter. Yeah.
yeah.
Peter, I know we're here for residential lending, but I just want to stress to everybody in the class, do not fear any type of property. If you see something that you think might be a good fit for a client, or if a client comes to you and says, "Hey, I'm looking for X, Y, and Z," and you're not sure if it's possible or if there's something that even exists, by all means, that's what I'm here for. Please just send me that property link, send me any kind of description, and I can tell you what type of financing is available. If you want to put me in touch with your client, that's great. If the client would rather you be the in between, that's fine too. I'm happy to help, basically.
Awesome.
Somebody just said, where should I go apply for one of those
Well,
mortgage
hold
loans
on,
you
and we'll
cover?
just everyone needs to click on this attendance code 11326. You need to click on that in order to make sure you get the proper credit. And now it looks like we do. Where should I go to apply for one of those mortgage loans you covered? Obviously, I think Amul would
I'm
like
going
you
to
to
send,
go to
yeah,
him.
I'm going to send a link. Okay, I'm going to send you the link actually for my commercial. And the reason being is that the commercial link will allow no matter what state you're asking about. So if you have a property, even if you're doing a referral to another state, I can handle everything right through there.
Awesome. And you will be receiving an email with the slideshow, and you'll have Amul's information there as well. So, just keep in touch. And Amul, thank you so much for all the information today. You were great.
Yep,
And
my pleasure. And so on the very last slide is my direct information, which you'll also get. And you can go right to the website or shoot me an email, and my email will always have a link for the application.
wonderful. All right. Thanks for joining us, everybody, today. And Amul, thanks again.
My pleasure. Thank you.
Bye bye.